The scene is intense as Scott Bassan enters the Treasury's secure auction room. The air is thick with tension, and the monitors on the wall flash red, indicating that the market is in turmoil. Inside the room, the traders are silent, their fingers furiously typing emergency orders to avoid the embarrassment of a failed auction. The 3-year Treasury note auction is just minutes away from closing, but foreign bids, once the backbone of these sales, are nearly non-existent. Outside the room, the news breaks. China's 10-year government bonds are now yielding just 1.7%, a historic low. This isn't just a financial statistic, it's a seismic shift in the global economic landscape. The United States 10-year Treasury yield is at 4.28%, more than double China's. This stark divergence isn't just about numbers. It represents a deepening political and economic rift. In a world where cheaper money often determines global influence, the widening gap between the yields signals a realignment of power. The gap between the US and China's yields isn't some slow trickle, it's a waterfall. China's entire yield curve, from the 2-year to the 30-year, has been falling together. Beijing is now able to tap long-term capital at costs that Western governments haven't seen in decades. Meanwhile, the US yield curve remains high, unmoved even by the Federal Reserve's recent rate cuts. Mortgage rates, which are closely tied to the 10-year Treasury yield, stay stubbornly above 6.5%, despite the Fed's attempts to ease borrowing costs. The next day, the 10-year Treasury auction delivers another blow. The participation from foreign indirect bidders, including central banks and sovereign wealth funds, is the weakest it's been since 2023. Yields rise during the sale, indicating that buyers are demanding higher returns to take on US debt. This is no anomaly. It's a growing trend. By day 3, the 30-year Treasury auction fares even worse. Foreign demand is at its second lowest level in 5 years. Yields jump across the curve as traders now view these auctions as events fraught with risk. In just 3 days, Bassan has witnessed the global market send a clear message. US debt is no longer worth the price being asked. China's role in these auctions is no accident. Treasury data reveals that Beijing's holdings of US government debt have dropped to about $756 billion, the lowest since March 2009. China has been steadily reducing its US debt holdings for months, redirecting its trade surplus into gold, domestic banks, and loans under its Belt and Road Initiative. Some of these loans, denominated in US dollars, are even being offered at rates lower than what the US government is paying to borrow its own currency. The shift is significant. In some African and South American capitals, it is now cheaper to borrow US dollars from a Chinese bank than from the US Treasury itself. Bloomberg terms this an inversion of the credit hierarchy, a phrase that would have been unthinkable in the financial world just 2 decades ago. Japan, the largest foreign holder of US Treasuries, has also slowed its buying as its own yields rise. Meanwhile, Middle Eastern sovereign funds are funneling capital into infrastructure projects and tech investments, where returns are more attractive than the yields offered by US bonds. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way. In response, the US Treasury has adopted a tactical strategy: avoid locking in expensive 30-year debt and instead flood the market with short-term Treasury bills, maturing in under a year. This approach keeps the near-term interest bill manageable. However, it's a short-term fix. Over the next year, $9.2 trillion of existing US debt will need to be refinanced, most of it issued when rates were lower. Add to this $1.9 trillion in new borrowing to cover the deficit, and the total refinancing need exceeds $10 trillion. In a market where foreign demand is dwindling, this refinancing treadmill is dangerous. The irony is hard to ignore. The US still markets its treasuries as the world's risk-free asset, yet investors now demand a higher return to hold them than to lend to countries with less economic history and greater political control. In market terms, the US is paying a trust premium, and that erosion of trust is being felt throughout the economy. Mortgage rates haven't budged despite 3 Fed rate cuts this year. Auto loans and credit cards are more expensive. Even municipal bonds are costing cities more to issue. The Fed's rate cuts affect short-term lending, but not the long-term rates that drive mortgages and corporate borrowing. This trend is starting to impact corporate America as well. Data from Refinitiv shows that U.S. investment-grade bond yields are now nearly double those of comparable Chinese issuers, eroding the ability of American companies to invest at competitive rates. This shift is not just about the numbers, it's about how the world's most powerful economy is slowly losing its edge in the global capital markets. The situation is not without its larger implications. Treasuries have long been the benchmark for global risk-free debt, but as foreign investors step back, the U.S. is finding itself increasingly reliant on domestic buyers who demand higher yields to absorb the debt. This dynamic is creating a self-reinforcing cycle. The higher the yields, the more expensive future debt sales will be. The U.S. debt market is facing a fundamental shift, one that Washington can't easily reverse. Meanwhile, China's capital strategy highlights the long-term challenges for the U.S. Rather than recycling its trade surpluses into U.S. treasuries, Beijing is investing in global infrastructure, commodity deals, and equity stakes. This means that China is no longer automatically buying U.S. debt with its surplus, fundamentally changing the flow of global capital. The Belt and Road Initiative is a case in point. China's loans, which average interest rates of around 4.2%, are undercutting Washington's borrowing costs. This allows China to expand its influence across Asia and beyond, without firing a shot. While the U.S. struggles to keep up with rising debt service costs, China is funding its global ambitions at a fraction of the cost. By the end of the year, the interest on U.S. debt is set to exceed defense spending for the first time in modern history. While this doesn't present an immediate risk of default, it does reduce the government's ability to maneuver during a crisis. The Federal Reserve, for all its efforts, can't fix foreign demand with rate cuts alone. To restore appetite for U.S. debt, the government will need to either offer higher real yields or convince investors that the long-term fiscal path is sustainable. If you found this video insightful, don't forget to hit that subscribe button. Stay tuned for more updates and content. We've got plenty more coming your way.